Yield-bearing stablecoins are digital currencies designed to provide both stability and interest generation. Pegged to fiat currencies, typically the US dollar, they function as stable digital money, maintaining a consistent price. What differentiates them is their ability to accrue interest, similar to savings accounts or bonds. These tokens enable businesses to hold stable currencies while earning a return on their holdings. For example, consider depositing USDC or USDT into a decentralized finance protocol. The platform takes these deposits and invests them in low-risk strategies, generating a steady yield. The stablecoins themselves are typically backed by other stable assets, ensuring they retain their value while offering returns. How do yield-bearing stablecoins work? Yield-bearing stablecoins function similarly to traditional savings accounts. When users deposit their funds into a platform, the assets are pooled and utilized in various revenue-generating activities. These may include lending through decentralized platforms, staking, or investing in real-world financial instruments. The earnings generated are then distributed to users, providing them with a passive income based on their holdings. These protocols can use various yield generation strategies such as DeFi lending and borrowing. Decentralized platforms like Aave and Compound allow users to lend their digital assets in exchange for interest. These protocols pool funds and issue loans to other users, with interest rates determined algorithmically based on supply and demand. This offers a way to generate yield without actively trading or managing assets. Some blockchain protocols, particularly those using proof-of-stake (POS) mechanisms like Ethereum, allow users to stake their tokens to help secure the network. In return, stakers receive rewards in the form of additional tokens. This method provides a steady yield while supporting the stability of the network. Why yield-bearing stablecoins matter? One key motivation for yield-bearing stablecoins is to mitigate inflation. Regular stablecoins maintain price stability but do not generate interest, which means their purchasing power can erode as inflation increases. In contrast, yield-bearing stablecoins do offer interest, helping to preserve purchasing power and making them a more appealing option for storing wealth. Stablecoins with built-in earning mechanisms provide a way to generate passive income without the need for active trading or investment management. By holding these assets, users can earn interest in a manner similar to a traditional savings account, offering a hands-off approach to accumulating returns in the digital economy. As DeFi matures, the introduction of yield-bearing stablecoins signals the development of more sophisticated financial instruments within the space. These assets offer a safer and more reliable means of generating yield compared to high-risk DeFi farming or staking, making them attractive to both retail and institutional investors. Stable assets create new avenues for earning low-risk returns, especially for users in regions where traditional financial products like treasury bills are limited or unavailable. This enhances financial inclusion by offering individuals and businesses in underserved markets the chance to grow their wealth. The decentralized nature of these platforms removes traditional barriers, fostering broader participation in global finance. Custody and transparency. Standard yield generation methods in DeFi, such as staking or yield farming, usually require users to lock up funds, reducing liquidity and flexibility. Yield-bearing stablecoins, however, provide liquidity while still earning interest. Users retain full control, allowing them to transfer, withdraw, or spend without interrupting interest accumulation. This flexibility makes them attractive, especially for those seeking to keep their holdings accessible while benefiting from yield. One of the largest criticisms of regular stablecoins like USDC and USDT is that while they are backed by billions in reserves, these reserves often generate significant yields that are not shared with the holders. For example, Circle, the issuer of USDC, holds over £25.84 billion worth of US dollars in reserves, much of which is invested in low-risk assets like treasury bills that generate interest. Tether, the issuer of USDT, holds the equivalent of £53.34 billion in reserves. Yield-bearing stablecoins aim to correct this by ensuring that the yield generated from reserve assets is distributed to holders. This creates a fairer system, where the benefits of holding stablecoins are more aligned with the interests of the users. While assets offer an attractive way to earn passive income, there are several risks that users must be aware of. One of the main challenges with yield-bearing stablecoins is the inconsistency of returns. In the highly unpredictable world of crypto, sudden changes in market conditions can impact yield generation. For example, sharp drops in asset prices may lead to lower returns or even losses. Since most yield-bearing stablecoins rely on decentralized finance platforms like Aave, Compound, or Maker, any vulnerabilities in these protocols can affect the stablecoin's performance. Bugs, hacks, or sudden changes in protocol governance can disrupt yields or even cause loss of funds. Collateral risks and devaluation. A sharp drop in the value of the backing assets could destabilize the stablecoin, potentially causing it to lose its peg to fiat currency. This instability may reduce returns or result in losses for holders. Many DeFi protocols have automated liquidation systems that trigger when collateral values fall below a set threshold. This can result in forced sales of the backing assets, impacting the stablecoin's value and the returns it generates. Regulation, risk, and liquidity. Increased scrutiny. If yield-bearing stablecoins are seen as competing with traditional banks, they could face regulatory hurdles or limitations. For instance, governments might impose new rules on how these stablecoins operate, potentially reducing the yield or restricting their use. Legal challenges. Regulatory changes may force certain projects to shut down or alter their operations. For example, some yield-bearing stablecoins could face issues with securities laws, particularly if regulators view them as financial products. Smart contract bugs. Even well-reviewed smart contracts can contain bugs or flaws that may be exploited by hackers. If the smart contracts governing the yield-bearing stablecoin are compromised, it could lead to loss of funds. Security breaches. Yield-bearing stablecoins are also at risk of being targeted by malicious actors. Hacks on DeFi platforms that generate yield could lead to the loss of collateral or prevent the stablecoin from continuing to generate interest. Yield-bearing stablecoins can face liquidity issues, especially in stressed markets. If demand for a particular token drops, holders may find it difficult to redeem or sell their tokens. Some yield-bearing stablecoins are backed by less liquid assets, such as long-term bonds or staked investments. If these holdings cannot be converted to cash quickly, the stablecoin may struggle to maintain its peg or payout yields. Yield sustainability. The sustainability of the yield provided by these tokens is another concern. While initial returns might be attractive, they may not always remain consistent due to economic conditions or changes in DeFi protocols. Global interest rates and broader economic conditions can impact the ability of these protocols to generate income. For instance, if traditional returns from treasury bills or bonds decline, it may affect the performance of stablecoins that rely on these instruments. Leveraging DeFi for business. These financial instruments represent a significant innovation in the crypto and DeFi space, combining the stability of regular stablecoins with the potential for passive income. They offer a way for users to combat inflation, earn interest, and access borderless, low-risk returns. However, they come with risks, including inconsistent returns, collateral volatility, and regulatory uncertainty. Businesses must carefully weigh these risks and stay informed about the platforms and strategies involved. As this asset class continues to evolve, interest-generating stablecoins could become a cornerstone of DeFi investment strategies, offering secure yet flexible opportunities for earning. However, the market is still young, and participants must remain vigilant, keeping an eye on both technological developments and regulatory changes that could affect their viability. For insightful FAQs related to this post, visit the CoinLink blog by clicking on the link in the description. CoinLink, connecting your business to the future of money.